Oil is exploding. Brent just hit $90. WTI is breaking above $84. Hormuz shipping has virtually stopped. 5 tankers Saturday, 0 Sunday. This is serious supply risk. I'm watching Brent at $90 and WTI at $85 for breakouts or rejections. 4 exact trade setups in the full breakdown, but the technicals are overbought. Watch this before you trade. The Strait of Hormuz is effectively closed. Let me say that again. The most critical choke point for global oil shipments, the waterway that carries roughly 1/5 of the world's seaborne oil, has virtually ground to a halt. Over the weekend, ship tracking data showed only 5 commodity vessels transiting the strait on Saturday and none on Sunday, compared with 31 vessels the prior weekend. That's not a slowdown. That's a shutdown, and oil prices are responding exactly as you'd expect. Brent crude is testing the $90 psychological barrier. WTI is pushing toward 85. Both benchmarks have surged more than 5% in the past week. But here's the thing. I've been trading oil for over 2 decades, and I've seen this movie before. Geopolitical spikes are violent, but they're also fragile. The question isn't whether oil is going up. The question is whether this rally has legs or if we're setting up for a classic headline-driven fake-out. What stands out to me is not the price action itself, but the underlying supply-demand dynamic. The market had previously discounted conflict risk as participants hoped for. Progress in US-Iran negotiations. That backdrop has now completely changed. Iran's foreign minister signals no decision yet on resuming talks, while US officials are preparing domestic audiences for somewhat higher fuel prices as long as the conflict persists. This rhetorical shift effectively sanctions a higher floor for crude. But there's a catch. And it's a big one. US crude inventories just surged by 17.4 million barrels to 424.4 million barrels, the largest weekly increase since January 2023. OPEC Plus is also planning to add 18.8 thousand barrels per day in September. So we have a market that's being pulled in 2 completely different directions: geopolitical supply risk on one side, and rising inventories plus production increases on the other. Today, I'm going to break down exactly what's happening with both Brent and WTI. I'll show you the technical setups, the fundamental drivers, and most importantly, my precise trade strategies for the next 24 hours. You're watching Trade Meridian Decoded, and this is your dual asset oil breakdown for August 18th. Here's my immediate read on these 2 benchmarks. For Brent crude, the weekly trend is bullish, the daily trend is strongly bullish, and we are testing a critical psychological level at $90. The key invalidation level is 88.70. If Brent breaks below that, the bullish structure starts to unravel. But if we hold above that level, I see upside potential to 91.45 and ultimately 94.10 for WTI crude. The weekly trend is also bullish, and the daily trend is bullish with a bull flag formation developing. The key invalidation level is $81. If WTI holds above that, the measured move target is approximately $93. The key resistance levels are $85 to $87, with immediate resistance at $83. Both benchmarks are in bullish territory, but they're also overextended in the short term. The RSI on Brent is at 68.3, which is approaching overbought. The CCI is at 272, which is deeply overbought. WTI shows similar readings with RSI at 67.7 and CCI at 272. So we have a classic tension, strong bullish momentum but stretched oscillators. Now before I get into the details, I want to hear from you. Are you trading Brent or WTI this week? And are you buying this breakout or expecting a pullback? Drop your thoughts in the comments. Let's start with the macro picture because this is fundamentally a geopolitical story, not a demand story. The dominant driver right now is not a sudden change in underlying demand, but fears of disrupted supply routes. The Strait of Hormuz remains critical, carrying a substantial share of globally traded crude and refined products. The immediate catalyst for this rally is the collapse of the US-Iran ceasefire framework. Washington and Tehran had signed a memorandum of understanding in June to end their conflict and begin negotiations on a final agreement. But that ceasefire has now clearly broken down as tensions over control of the Strait of Hormuz escalated. According to CNBC, Iran's foreign ministry spokesman has ruled out extending the memorandum. The Wall Street Journal reported that President Trump has warned the U.S. may attack Oman if it intervenes in Iran's blockade of Iranian vessels in the strait. On top of that, we've had direct attacks on oil infrastructure. ADNOC-operated tankers have been struck, and there was a drone strike on a Saudi Aramco refinery. Israel also carried out strikes on southern Lebanon over the weekend, killing at least 11 people. ING Bank reported Monday that the renewed fighting in Lebanon and the vessel attacks in the strait are supporting oil prices, with markets concerned about regional supply disruptions and the increasingly complex prospects for a US-Iran deal. But here's where it gets complicated. The fundamental picture is not uniformly bullish. U.S. commercial crude inventories surged by 17.4 million barrels to 424.4 million barrels for the week ending August 7th. That's the largest weekly increase since January 2023. The EIA noted that inventories are still about 2% below the 5-year seasonal average, but that's a massive build that should be. Weighing on prices, demand forecasts are also weakening. OPEC has downgraded its 2026 global oil demand growth forecast to 58,000 barrels per day, while the IEA expects demand to contract this year. The IEA has also projected that 2026 global oil demand will decrease by 1.6 million barrels per day year-over-year, with the deepest decline of 4.9 million barrels per day occurring in the second quarter. And then there's OPEC+. 7 OPEC Plus producers are planning to increase production by 18.8 thousand barrels per day in September. That adds another potential supply source to the market. So we have a market where geopolitical supply risk is pushing prices higher, but inventories, demand weakness, and production increases are providing a ceiling, as the CMB analysis noted. The recent price recovery is best understood as a rebuilding of the geopolitical risk premium rather than a fundamental demand surge. For a more pronounced and durable rally, markets would likely need confirmation of serious damage to tankers, key export terminals, or upstream facilities that removes barrels from the market for an extended period. Absent that, the current configuration points to elevated but range-bound prices, with volatility driven by headlines on each new incident in Hormuz or at regional refineries. The calendar for the next 24 hours is relatively light, but the week ahead is packed. Today we have API crude inventory data at 4:30 p.m. Greenwich Mean Time. Tomorrow is the big day with EIA crude inventory data at 2:30 p.m. Greenwich Mean Time, followed by the FOMC minutes at 7 p.m. Greenwich Mean Time. The EIA data will be critical. If inventories show another large build, it could put significant pressure on prices regardless of the geopolitical backdrop. Now let's get into the charts, starting with Brent crude. I'm going to weave the fundamental story right into this technical analysis because they're completely inseparable right now. Starting on the weekly time frame, Brent has been in a strong uptrend since the August lows. We've seen a series of higher highs and higher lows, and price has broken above key moving averages. The weekly close above the 200-day EMA at 85.51 is a significant bullish signal. The weekly structure suggests we are in a sustained rally phase, but we are approaching a critical resistance zone. Moving to the daily chart, this is where the action is. Brent is currently trading at approximately 89.77, having briefly touched around 89.40 before stabilizing. The daily chart shows price sitting comfortably above all major moving averages, the MA5 at 89.31, MA10 at 89.25, MA20 at 88.92, MA50 at 88.13, MA100 at 88.38, and MA200 at 85.51. That's a perfect bullish alignment. With all 12 moving averages signaling buy, the daily RSI is at 68.3, which is approaching overbought but still has room to run. The ADX is at 9.09, which is neutral. That's actually interesting because it tells me this trend is still developing rather than being fully mature. The MACD is positive at 0.440 and signaling buy. The Williams %R at -1.538 is in overbought territory, and the CCI at 272.6 is deeply overbought. So we have strong momentum but stretched conditions. The key levels for Brent are clear. Resistance sits at 89.50, $90, and 91.75. Support is at 86.80, 85.40, and 84.10. The daily pivot is at 89.11. The immediate resistance at $90 is the psychological barrier everyone is watching. A clean break above that level could trigger a wave of algorithmic buying and open the door to 91.45, 92.60, and ultimately 94.10, but there's a bearish alternative as well. If Brent fails below resistance and retreats, the first target would be 88.70, followed by deeper support around 77.59 and eventually $72 to $74. The path of least resistance, according to some analysts, is actually a fade back toward 80. 6.80 to 87.20 support. Now let's turn to WTI crude, where the story is similar but with some important differences. WTI is currently trading at approximately 83.44, up from around 82.80 at the start of the week. The weekly trend is bullish, and we are seeing a bull flag formation developing on the daily chart. A measured move from this flag pattern would lead to the next swing high somewhere around $93 if price breaks out to the upside. The daily chart shows WTI sitting above all major moving averages, MA5 at 82.69, MA10 at 82.32, MA20 at 81.86, MA50 at 81.78, MA100 at 82.31, and MA200 at 80.19. All 12 moving averages are signaling buy. The daily RSI is at 67.7, approaching overbought but not yet extreme. The ADX is at 21.3, which confirms a developing trend. The MACD is positive at 0.370. The Williams %R at -4.7 is overbought, and the CCI at 272 is deeply overbought. So WTI is also showing strong momentum with stretched short-term conditions. The key levels for WTI are slightly different. Resistance sits at $83, 84.60, and 85.90. Support is at 81.20, $80, and 78.85. The chart also highlights $85 to $87 as the main resistance zone. If WTI can break above $87 with conviction, it would strengthen the bullish structure and potentially open up a much larger move. However, the momentum indicators are less clear on WTI. The relative strength index is around 53, and the MACD is generally flat, suggesting WTI is in consolidation rather than acceleration. If WTI loses the $81 area, it would weaken the bullish structure, with the 200-day moving average at $78 providing the next significant technical reference. Let me give you a personal insight here. The spread between Brent and WTI has widened to about $6.12. That spread tells its own story about freight costs, quality differentials, and the increasingly regionalized nature of crude supply. I've been watching this spread for years, and when it widens this much, it usually signals that supply logistics are the primary driver rather than global demand. Brent is more exposed to Middle Eastern supply risks, while WTI is more influenced by North American production and storage dynamics. This is why I'm treating these two benchmarks as distinct trading opportunities rather than identical plays. 2.6 trade setups. Brent CRU. Now let's get to the part that actually matters, the trade setups. For each benchmark, I've got two setups, one scalp and one swing, with exact entry levels, stops, and targets. Brent setup 1. Scalp breakout above $90.00. The first Brent setup is a momentum scalp above the psychological $90 level. The trigger is a clean 5-minute candlestick close above $90 with follow-through. If we get that, I'm entering long. The take profit is 91.45, which is the next resistance level. The stop loss goes at 89.40, just under the recent consolidation range. That gives us a risk of about 60 cents for a potential gain of $1.45, which is a risk-to-reward ratio of approximately 1 to 2.4. Here's the thing about trading at psychological levels like $90. I've seen this play out dozens of times in my career, and the key is to wait for confirmation. A false break above 90 that reverses back below is a classic trap. So I'm not entering on the first touch. I'm waiting for a clean close above with a bullish candlestick pattern. If price breaks above 90 and then immediately reverses, I'll actually consider a countertrend scalp short, Brent setup 2, swing retest long at $88.70, $89.10. The second Brent setup is a swing trade that I'm positioning for a pullback. I'm setting buy limit orders in the 88.70 to 89.10 retest zone. This area coincides with the daily pivot at 89.11 and the key support level at 88.70. My take profit target is 94.10, which is the major resistance target from the bullish structure. That's approximately $5 of potential upside from the entry zone. My stop loss is placed at $88, just below the support level. That's a risk of about 70 cents to $1.10 for a potential gain of about $5. That's a risk-to-reward ratio of approximately 1 to 5, which is exceptional for a swing trade. I'll be scaling into this position gradually, adding on dips within the zone if the broader bullish structure remains intact. Now let's look at WTI crude, where the setups are slightly different given the bull flag pattern and the different resistance levels. WTI setup 1. Scalp breakout above $84.60. The first WTI setup is a breakout scalp above 84.60. Which is the first significant resistance level. The trigger is a clean 5-minute candlestick close above 84.60 with bullish momentum. The take profit is 85.90, which is the next resistance level. The stop loss goes at 83.80, just below the recent consolidation. That gives us a risk of about 80 cents for a potential gain of $1.30, which is a risk-to-reward ratio of approximately 1 to 1.6. The invalidation for this setup is a false break that reverses back below $84. WTI setup 2. Swing breakout at $87.00. The second WTI setup is a swing trade on a confirmed breakout above $87. This is the major resistance zone that, if broken with conviction, could open up a much larger move. I'm setting buy stop orders at $87 with a take profit at $93, which is the measured move target from the bull flag formation. The stop loss goes at $85, below the resistance zone that should now act as support. That's a risk of $2 for a potential gain of $6, which is a risk-to-reward ratio of 1 to 3. This is the higher conviction swing trade that aligns with the bullish flag pattern, but it requires patience and confirmation. Before we move to risk management, I want to pause and ask you something. I've given you 4 setups across 2 benchmarks. Which one fits your trading style best? The Brent momentum scalp, the Brent swing retest, the WTI breakout scalp, or the WTI swing breakout? Hit the comments and tell me your preference, and I'll share some additional thoughts. I need to be very direct with you about risk management because we are trading in one of the most volatile environments I've seen in years. Geopolitical headlines are driving this market, and headlines can change in an instant. I've been trading oil for over 20 years, and I've learned that geopolitical spikes are the most dangerous trading environments because they combine high volatility with extreme uncertainty. Here's my personal rule for trading oil in geopolitical crises. I reduce my position size by at least half compared to what I would use in a normal market. I never risk more than 0.5% of my account on any single oil trade right now. The reason is simple. When you're trading headlines, you're trading against algorithms that can react faster than any human. I've been on the wrong side of these moves before, and it's not FUND in 2022. When the Russia-Ukraine war first broke out, I was too aggressive on an oil position and got stopped out twice in a single session. That taught me a valuable lesson. In geopolitical markets, you don't try to catch the exact top or bottom. You wait for confirmation, you size appropriately, and you respect your stops. Additionally, I want to emphasize that both Brent and WTI are showing overbought conditions on multiple oscillators. The CCI on both benchmarks is above 270, which is extreme. When you see readings like that, you have to expect pullbacks. That doesn't mean you short the market. It means you're careful with your entries and you don't chase breakouts without confirmation. If you're trading the API data at 4:30 p.m. Greenwich Mean Time or the EIA data tomorrow at 2:30 p.m. Greenwich Mean Time, I highly recommend waiting for the dust to settle before entering. The initial spike on inventory data is often a liquidity grab, and the real trend doesn't establish for 30 to 60 minutes, so where does that leave us for the next 24 hours? Oil is in a position of strength, driven by a genuine geopolitical supply risk that has virtually shut down traffic through the Strait of Hormuz. But the market is also facing headwinds from rising U.S. inventories, weakening demand forecasts, and potential OPEC Plus production increases. For Brent crude, the key level is $90. A clean break and hold above that level opens the door to 91.45, 92.60, and ultimately 94.10. Support at 88.70 must hold to keep the bullish structure intact. My swing retest entry at 88.70 to 89.10 is the higher probability play for larger size. For WTI crude, the key level is 84.60 for the short term and $87 for the medium term. A clean break above $87 with conviction could trigger a move to $93 based on the bull flag formation. Support at $81 must hold to keep the bullish structure intact. Remember, we've got API data at 4:30 p.m. Greenwich Mean Time today, EIA data at 2:30 p.m. Greenwich Mean Time tomorrow, and the FOMC minutes at 7 p.m. Greenwich Mean Time tomorrow. I'll be covering all of these events as they happen, so make sure you're subscribed and have notifications turned on. Also, don't miss our Friday coverage of the Baker Hughes rig count data. If you found this dual asset oil analysis valuable, please give it a thumbs up and leave a comment with your thoughts. I read every comment and I'll be responding to the first 50. This is your trade meridian decoded, and I'll see you in the next breakdown.